Hey, it's Andrew here from Mortgage HQ, and I've got Ashley Church here, and he's a man of many talents, and he's been commenting on the real estate market for a long time now. So I've been reading some of his articles and brought him on board just to ask some questions about the property market. So why don't you give us a quick insight into who you are, and then we can crack into it.
Who am I? I don't think I've ever been asked that question before, so that's a new one. I guess in relation to the property market, I've been an investor and an observer of the market since way back in the mid-'80s when I was very young. Have developed, I guess, an appreciation of the history of the market. It's interesting, I refer to myself as a property commentator, but I would probably be more accurately called a property historian, because most of what I talk about is based on the history of the market and my belief that most of what happens in the market is based on cyclic trends. So I'm an observer of that market. Had a few roles of probably some more significance in recent years. Back in the early 2000s, I was the CEO of the Auckland Property Investors Association, and between 2000 and something and the more recent time, I was the CEO of the Property Institute of New Zealand, which is an organisation which primarily represents valuers, but also represents commercial property managers, residential property managers, property consultant, and plant and machinery valuers. So reasonably eclectic career, and have built up over a period of time a particular view, be it right or wrong, of what the market does and why it does it.
Yeah, I mean, it's a market insight based on lots of information coming to a funnel point. So you're kind of in the trenches, data analysis, but it's also combined that with a mindset for an opportunist mindset, I'm guessing.
Yeah, it's interesting you should say that. I mean, what I can tell you is that there have been, because there's a whole range of mythology around the property market, some of it correct, a lot of it not correct. And I think probably the one thing I have brought to that equation over the last 10 years in particular is that I'm prepared to have my own worldview challenged. And what I mean by that is that there have been topics that I've approached or attacked where I've gone into my research with not a predetermined, but some ideas about what I'm going to find, and actually ended up finding something very different. And I can think of 2 or 3 examples of those where my entire view of the property market has changed based on the fact that the data says something quite different to what I thought it would say.
And you're probably more keen on the data than I am, so that's why I want to have a chat. So,
that's fair.
What do you think is going to happen the next 3 to 6 months, based on what's in the media and the data that you're looking at?
Yeah, so the combination of data and media. So, and by the way, when I talk data, I'm talking about decadal trends rather than necessarily what's happening in the here and now. In fact, it's actually unhelpful to look at what's happening in the immediate moment. And the media has this fascination of picking up on slight variations as if somehow that becomes the new normal and everything's going to be influenced by that. When in fact, when you look at the market, it doesn't operate that way. It operates in sort of great broad swathes where, probably the best way to describe it, it's a bit like the teeth of a serrated saw, if you imagine, which goes slightly up and down all the time. The market operates like that. It's constantly responding and reacting to the things that are happening to it, but its general trend is upward. So if you go back over the last 40 odd years, lots of little movements all the time, but the general trend has been in an upward direction. And I've seen nothing to indicate that that's going to be any different. If I was to drill down a little bit more into my expectations over the next 12 or 18 months, and I was to base that on what I've observed of the market over the last 20 or 30 odd years, it would be that there are 2 trends operating, in very broad terms, there are 2 trends operating in the market at any given time. One of which is that the Auckland market's doing its thing.
Yeah.
Keeping in mind when I talk about the Auckland market, even that is a broad instrument because it
averages.
There's lots of markets within Auckland that do different things, but in a general sense, there's the Auckland market, and then, and this is even more generalised, there's sort of the rest of New Zealand, regional New Zealand. I mean, if I was going to drill down, that's actually got its own variations, but in a general sense, the Auckland market is about 3 years ahead of the rest of the country. So what that means is that the Auckland market goes up, it flattens off for about 6 to 7 years. In any decade, it flattens off for about 3 years, and then it picks up again and starts another cycle. And that started in 2020, right on cue. So between 2017 and 2020, the Auckland market flattened. And if you look at a graph of what happened over that time, it's a very, very good indication of what a flattening looks like. And then in 2020, it started picking up again. And so if it continues what it's done over the last 40 years, that should carry on for another 5 or 6 years. So if you live in Auckland and you're buying and selling property in Auckland, you can expect property, if that trend continues, to go up over the next few years by whatever rate, and we can talk about that later. The rest of the country is 3 years behind. So what should have happened to the rest of the country is it should have continued going up between 2017 and 2020, which is exactly what it did. 2020, it should have flattened off. So it should have gone into its cyclic flattening, and then it should have picked up again about 2023. Now, as we all know, it didn't. It carried on at a breakneck pace. And in fact, over the last 12 months, most of the country has seen more house price growth in that 12-month period than in any other period in its history. There's a whole range of reasons for that, which are related to the peculiarities of COVID and what happened and how the Reserve Bank responded to that and what it did to monetary supply and stimulus and a whole range of other things. But if the market's now returning to normal, then I would expect next year, either immediately or at some stage during the year, for the regional markets to flatten. And if they do, they'll stay flat for 2 or 3 years and start picking up again about 2024 and doing their 6 or 7 year climb. So that's a very broad swathe. Like, you know, if I got down into the granular detail, I could sort of analyze that more, but in a general sense, that would be my expectation.
Yeah, and the dangerous thing about flat growth in the regional towns is it's okay if there's cash flow and it's strong, but because prices are relatively high and rates are going up, the cash flow is much harder to come by in those places. So if you're not getting the gain, then it might be more drama than it's worth. And people...
Well, I think that will actually change the nature of property investment because the possibility of getting a cash flow property in Auckland is gone. The possibility of getting a cash flow property outside Auckland is increasingly diminishing as a reflection of the fact that that gap between rents and house prices is getting greater and greater. But so I think what will happen is that smart investors, people who recognise capital growth as an inbuilt part of the system, will continue to persevere with the market. So they'll recognise that for 3 of 10 years that those things are going to be a net cost and they're not going to make any gain on them. But over the 10-year period that those properties are going to broadly double in value. So what it means is that it's going to take a lot more perseverance and wisdom and understanding of the market to continue to be an investor. But for those who do, that capital growth, which to be fair, Andrew, has always been the primary reason for investing in the long term, will continue to be the case.
Yeah, I think generally speaking, people are comfortable with negatively geared properties in Auckland, knowing that safer location. Yeah, and there's barriers to entry in that you need borrowing power and you need cash, and there's only so many people that have that. And So, and with the lending rules becoming even tougher, it's I think the cashed up investors are not necessarily going to have the pick of whatever they want, but certainly less competition. So they will still do negatively geared properties, knowing that they're not stupidly overpaying, just paying what they have always expected to have to pay.
Yeah, I agree with all of that, except, and what I'm about to say, keeping in mind that you're a greater expert in this than I am because you deal with the financial side of things every day. I don't think that the current slavish adherence to the new legislation is sustainable. I think it's been applied to, whether by the banks or whether by the wording of the legislation itself. I think it's simply too much of an overreaction to the market. And that's going to have to break. You know, whether it takes 12 months or 18 months or however for maybe an incoming government to change it, something about that legislation is going to have to loosen up a little bit, because if it doesn't, it'll spell the death knell to a whole range of people that won't be able to get it the first times.
Yeah, and there's not going to be too many bank CEOs that want to have declining quarters, quarter on quarter on quarter. So, they want to get their lending book going up. So at the moment they're behaving themselves voluntarily. I suspect there'll be a lot of pressure, a lot of lobbying behind the scenes that we might not be privy to try and make adjustments.
Agreed.
So the lending guidelines was already relatively strict before this came in. The banks were taking a lot of steps to protect people from borrowing what they couldn't afford, and the non-bank specialist lenders, they're not giving them money away for free. They're doing a lot of their own due diligence. So it's not like the movies or The Big Short, where people have been getting money for anything.
No, I think this was an overreaction to a non-existent problem, to be honest. But time will tell on that.
Yeah, well, it seems to me the political risk is definitely the biggest risk on property market at the moment. No, I don't think many people would have predicted taking away the interest deductions or it's getting a lot harder to make money in the property game. And I don't think the government in play at the moment was going to say, hey, let's make it easier.
No. Interesting you should raise that, because, I mean, me as an investor who's been around for a long time and so, who has had the advantage, and I use that word loosely because it was simply applying international tax law. But if you want to see it as the advantage of claiming interest as a deductible expense, or the advantage of treating one form of income against another when it came to compiling my tax at the end of the financial year. All of those things have been part of the game for a long time. But here's what's interesting. For anybody who gets into the game from this point onward, those things were never there. And I can think of a parallel to that. And you may or may not be aware of this, but probably going back 15 years now, but you used to be able to claim depreciation against the constructed dwelling when you were buying a property investment. So if you bought a home, the construction part, the house, the dwelling, you could claim initially up to 4% of the value of that dwelling in any given year as a depreciable expense. And then the government reduced that to 1%, and then it got rid of it altogether. And the reason they got rid of it was because it was a nonsense to be able to claim depreciation on an asset which invariably went up in value. But for people who used to be able to claim that, that was a massive change to the ground rules. Yeah. And so for them, it was a really big hit. For other people who were getting into the market after that, they'd never had it, so they didn't miss it. I suspect that will be true also of some of these changes that have been made. Now, whether an incoming National Act coalition government might change that, time will tell. But even if they don't, and I hope they do, but even if they don't, that will just become the new normal.
Yeah, I generally say, hey, if you believe that governments come and go, and there's some time in red and some time in blue, and they swap around, you just have to have faith that anything that doesn't make financial sense, it will get changed back. And especially if ACT is a strong component of any changes, not holding my breath, and it is a long way away. But it's definitely more people looking at commercial and into crypto and into different kinds of investing, because property, one of the things I'm thinking a lot about, we got a big firm of people here, is if the property market does die down a bit, then how are we going to advise our clients on making use of their equity and investing in? And so investing into businesses, commercial properties, syndications, just thinking outside the box and looking more holistically instead of just with a narrow property focus. I think people are going to start having to, instead of thinking, I need to buy $1 million investment property that only it costs me X each year, then maybe I've got to find something that I don't need the debt to get, and maybe I can get a positive return. Interesting times. Certainly, we've only been doing this about 6 years, and it's been rates down, property up. That's all we've known. And I think that my generation, certainly mid-30s, we haven't seen 10% interest rates. We haven't seen 10% inflation. We haven't seen property prices fall a lot. And I'm not saying it's going to happen, but it could.
It's interesting you should raise that. So I don't think we will see 10% interest rates, and I'll tell you why. Because if you think about what's happening at the moment to interest rates, the Reserve Bank's not doing that in reaction to what's happening in the housing market. It's doing it in reaction to what's happening with inflation. So the Reserve Bank has a function which is to keep inflation within 1% and 3%. And they use interest rates as a way of essentially achieving that goal. So when inflation, when we're getting to a point where there's no inflation, then the Reserve Bank will typically drop interest rates in order to stimulate activity. When we're in a period like we are now, when inflation looks like it might get out of control, they'll increase interest rates and the opposite effect in order to reduce activity or to take the boil off the market. So the reason I say that is because once they get inflation under control, and they will, Andrew, they'll get it under control, and it may be quite quickly, then the need to increase those interest rates will go away. And potentially even there'll be some reason there to actually drop them again. So I wouldn't imagine, and let's watch the space, but I wouldn't imagine the interest rates will get much past 5%. They may sit there for a while, but my expectation then, once inflation's back where it's been, that band it's been in for a really long time, is that they'll start to come down. I just don't see anything that would suggest to me that they will ever get back up to that sort of 10%, 15% mark they were historically again, because it was a completely different environment and ballgame in those days.
I think there's been a hit to the growth and the excitement in the market because of the interest rate changes, and that has definitely impacted things. And I can't. There's so much margin for the banks at the moment with the rates that they're charging.
Yeah.
Can't see the need to keep going.
No.
Unless political pressure or, because, Australia, America, like all around the world, the rates are still very low. When you just look at Australia and the interest rates are still just so incredibly low compared to what we have here, it's hard to understand why we have what we have. And
to be fair to the Reserve Bank, and I've actually been pretty hard on them over the last 6 or 7 years because they've lost a little bit of that sort of authority that they used to have. But even putting that aside, the period since the passing of the Reserve Bank Act in 1989 has actually been a remarkably benign period for our country, and it's led to, through 3 or 4 different governments, a very, very stable economy for a long time. And that's primarily because the Reserve Bank has managed to control that inflationary growth over that period of time. It's taken its eye off the ball a little bit over the last 4 or 5 years, and that's not entirely its own fault. Part of that's been caused by this government coming in and thinking that it could use the Reserve Bank as its plaything for a whole range of other objectives. But back when its focus was primarily inflation and nothing else, it was very, very good at what it did. And I'm still confident that it'll return to that original remit.
Yeah. The entity, the Fed or the Reserve Bank, they might be doing a great job. I find where they go wrong is when whoever's in charge opens their mouths sometimes, and then within 2 or 3 weeks, history comes and slaps them.
Yeah, it's really interesting because if you go back over that 30-year period, they've actually been pretty good at picking trends for a long time. And I'll tell you one thing they never used to do, and they've started doing now. If the Reserve Bank, if the governor came out during an OCR round and he said, because it's always been a he, if he said, I'm not going, and it was June, and he said, I'm not going to raise interest rates until November, you could guarantee you could put your money, no pun intended, on he wouldn't raise it till November. Yeah. That's changed. And Adrian Orr's made a couple of statements where he's given quite long time frames where 2 or 3 months later he's changed, and that's absolutely the kiss of death for an institution that underpins your monetary system. I've noticed it too many times over the last couple of years for it to be an accident or a one-off thing.
Yeah, I know people are starting to talk about whether he needs to go or not, and that's not something
not
you ever want.
Bank governor, no.
Yeah. So what's scaring you most about the new year in terms of property and the economy?
Well, the property, not much is scaring me. Other than what I said before, if I was in Auckland, I'd have some confidence that the market will continue the house prices will continue to increase, albeit much more slowly than they did over the last 12 or 18 months. That growth will probably go back to the long run average is about 7.2%, which incidentally 7.2% per annum means doubling your house price in 10 years. And they'll go back to that long run average of about 7.2% in Auckland. The rest of the country, and this will happen to varying degrees in different parts of the country, I think will flatten off. I don't see a house price crash for a whole range of reasons that I won't get into, but I do see a flattening of those prices in the regions for probably a 2 or 3 year period. With respect to the broader economy, I have got some concerns, and they relate mainly to the harebrained management of our economy by people. We've got people running the economy of the country at the moment who, in my view, simply don't know what they're doing. And we've got some very, very big challenges ahead as a result of the consequences of some of the things that are going on right now, not the least being the extent of borrowing which is taking place, ostensibly to deal with COVID. But when you actually drill down and look at what it is and what it's being used for, to actually to implement what I see as a huge ideological experiment on our nation.
Yep. And this definitely poses a risk to property investors because it's unpredictable.
Yep, absolutely.
Yeah. And so you're faced with a scenario as an investor, you say, well, do I sit on the sidelines and wait, until they're not there anymore? Or do you take action and hope for the best and protect yourself however you can?
Well, perversely and ironically, property investors who've been hit really hard by this government, if you look at capital growth, which, as I said before, is probably their primary reason for being involved in property investment, that's actually done remarkably well under this government. They've probably added 30 to 40% of the value of their properties since Labor came into power. So there's a certain irony in that. And if you were just looking at it, if you were ignoring the best interests of your country and simply looking at it in terms of the value of your asset, you might want more of this for a long time. The problem with that, of course, is if you're an investor, is that the poor old tenant ultimately ends up paying. And so we've got a situation at the moment where we've got rapidly rising rentals as a result of some of the changes that this government's made to the rental market over the last 4 years, which were, in theory, were designed to improve a lot of the tenant, and in fact, they've actually made it much, much worse financially.
Yeah, I see it as an anchoring effect. One of my other businesses just tried to hire a part-timer, and she loved the opportunity and she was really keen. And then, the part-time aspect, that was good for her until she realized that she was going to lose a bunch of her benefits. And it actually really didn't really make sense to come and work when you get the money for free.
No.
And so now I'm faced with the dilemma of, okay, I've probably got to hire someone much older if it's going to be part-time, which that's totally fine. Or I got to hire someone full-time, otherwise it's not an attractive prospect. And that's a dangerous flywheel to be turning. The benefits are getting bigger and bigger and bigger, and I just don't understand how that's going to help the economy.
Yeah, it's interesting. I mean, I don't believe that there's any such thing as a perfectly configured economy. I just don't think it's possible. Because even if you got the settings right, other things would change as a consequence of that, which would mean it would get out of sync again. So you constantly have to fiddle with it. But if there was ever a period of our recent history where we had it pretty much or close to right, it was under Bill English as finance manager or finance minister, where settings may not have been perfect, but we had it working pretty well. And these guys have come in and they've, in my view, tinkered with something that was working. It's a bit like kid who comes along, pulls a toy apart, thinks they're going to put it back together, and then realizes they don't know how to put it back together. That's essentially what's happened over the last 4 years.
So do we need to change the way that leaders run the country democratically? I could never run a hospital. I got no medical background. And I would never believe that even if I was the CEO of a hospital, that I would be meddling with all the medical practices.
In general, no. Because again, if you go back over 30 years, and I'm talking multiple governments of both flavours, Michael Cullen, who under Labor was an extraordinarily good finance minister. The difference with those finance ministers was that they had, firstly, they had an agreed orthodoxy that both governments stuck to around, if you want it, for want of a better word, neoliberalism in terms of economic management, which had worked for 30 odd years around the Western world, not just here. And so both governments, although they might have disagreed on the margins, they essentially both agreed to the economic framework within which they were operating. The difference here is not that they didn't understand. It's that they deliberately imposed an ideology which was at odds with what we've been doing successfully for 30 years. And in my view, that's the cause of the situation we find ourselves in at the moment. It's not because they didn't understand how to run that part of the economy. What they should have done was they should have stuck with what we had, the previous pattern, which had worked so well for us, and they chose ideologically not to do that.
Yeah. So where are you going for your source of truth, so to speak? Where are you getting your information relating to property and investing and just collecting your thoughts together?
Yeah, and probably a caveat I should have put at the beginning was I'm not an economist. I don't have a degree. All of the things that you would tick off in order to take somebody's opinion seriously, I don't have. So my observation...
You should be a politician.
Well, I don't think I'll be much better at that. So my observation and my commentary, Andrew, comes from observation over the last 40 odd years. And it's interesting because that's changed. So the one thing I do have going for me, and I think probably holds me in good stead and enables me to continue doing this reasonably effectively, is that I'm prepared to change my view based on evidence. And so, over that last 30 or 40 year period, I've looked at lots of, for example, if you'd asked me 10 years ago what caused house price inflation, I would have told you it was a combination of immigration and 2 or 3 other things that were drivers. And I've changed my view substantially on that. I'm now very clearly of the view, as a result of looking at the data and looking at what's happened over the 40-year period, that the cause of house price inflation is unequivocally 90% of the cause of that is interest rates, reducing interest rates. You can see that link clear as the nose on your face if you simply look at it and are prepared to treat the data for what it is. And all those other things that we blame, property investors, ghost homes, foreign investors, immigration, all that other stuff might have a marginal effect, but it's tiny. Supply, all those other things. So what I bring to it and where I get my information is just that constant thirst to continue to better understand the market and to understand those trends. And of course, the more time that passes, the easier it is to do that, because although, and I'm criticised all the time by people say just because it did that in the past doesn't mean it's going to do it in the future, and there's some truth in that, except that it does, except that of every 10-year period I've observed, it does follow the same cycle. It does follow more or less the same pattern. So although it won't necessarily do those things, it certainly has done so far.
Yeah. And the trends, certainly in the share markets, so you see sometimes the cycles can get a lot shorter.
Yep.
And maybe that'll happen this time around. It's hard to tell. Yeah. And
I mean, there's an argument that says, because if you bought a house in Auckland in 2000, that was about 4 times household income. It's now about 9, possibly 10. In fact, it's probably more than that now as a result of the last 12 months. And there is an argument legitimately that says that can't keep getting out of kilter. And you must get to a point where that breaks. And I agree, you must. I'm just not sure whether we've reached that point yet, and if we haven't, where that point actually is. And that's something that I'm actually keen to do some analysis on, to actually have a look at, because the other thing you've got to factor into that is interest rates. So if you factor those 3 things together, you should be able to work out where you reach a point where it's unsustainable. What I can tell you is, if you go back to the 80s when interest rates were at about 21%, even though house prices were much, much lower than they are now, if a couple in Auckland bought the house at the median price in Auckland, who were on the median household income, then the cost of servicing that mortgage in the 80s was about 52%. In other words, just over half of your income went to servicing your mortgage.
Yeah.
By 2017, that figure had dropped to 37. Yeah. So even though house prices had gone up and incomes hadn't gone up by nearly as much, because interest rates had come down so dramatically, it was actually costing that couple less out of their household income than it was 35, 40 odd years ago. And that's a hard thing for people to get their head around, but it's just a fact using the numbers.
Yeah, and there's so many more couples around with dual income now than, so, and people are having kids later, so in theory should be saving a bit more earlier in life, and there's a lot of factors work in their favor, and transport, you can go further out.
There was one big change though, and if you go back to the early 2000s, that young couple buying a house could go to the bank, and the bank would lend them a house on a deposit of 5%. So if it was their first home, and the house was, let's say back in the mid-2000s, our home was, $300,000, then they could buy that house on a $15,000 deposit. When you're talking about a 20% deposit, as we are now, and the house is $1 million, that equation starts to get much, much more difficult for that same couple.
Yeah, I started reading a book from the other side of the fence, and I can't remember what it's called now, but it's from what I perceive to be quite a left-wing guy. Something about, it's called Too Much Money or something like that.
Sure.
About how what's happening now is a cycle of rich families and parents helping their kids, and there's no real solution to that, and life is not fair, right? Some people are born taller and some are born shorter, some are born smarter and some are not, and some are born with privilege from parents being, even if it's barely, but parents owning property, having equity that they can help their kids with. There's a lot of people that don't have that, and it comes back to the ideals.
Yeah, you would see that because you're dealing with situations where you know whether or not parents' equity is being brought into that equation. But I don't entirely accept that. I mean, I look at my own situation. I'm certainly not the beneficiary of any privilege whatsoever. I come from a state house in a large family in a lower socioeconomic area in Hawke's Bay back in the 60s and 70s and 80s. And I've had no advantage during my life. And I say that not to show off, but simply to indicate that I'm indicative of tens of thousands of Kiwis, tens of thousands of New Zealanders who went through that very situation and have got on with their lives and have made things work. And I'm going to sound like an old curmudgeon now, but to be honest with you, if that had come to me easier, I'm not sure I would appreciate it as much. So there is an argument for that sort of rite of passage that you go through to get to that point in your life. And I don't think that's any different. I don't think it's harder or easier. I think it's just different in terms of the detail, but no different in terms of the outcome. And I'll tell you what's really interesting is I talk to young couples, and this is really interesting, and I see it so often now that I've recognised it as a thing. So a young couple will get, let's say it's a couple, will get a mortgage approval. They'll go to somebody like you and they'll get a mortgage approval, and up to whatever amount, and they'll go to an auction or they'll go to a tender and they'll make an offer and they'll miss out.
Yeah.
And then they'll go to another one and they'll miss out again.
Yeah.
And they might get to their third or their fourth. And by the time they get to the fourth one, they're coming to you or they're coming to me or they're coming to somebody else and they're saying the system's broken.
Yeah.
It's unfair. The government should do something. It should change it because it's impossible to buy a home. But they'll keep going through the process. And on their sixth or seventh, they'll get one. They'll
Yeah.
buy a property. And I'll tell you what happens, and you will have seen this.
Yeah.
On the day of settlement, their entire worldview goes like this. And
Yeah.
suddenly, the system's brilliant. Don't change a thing. I love capital growth. I want my property value to go up. Don't
Definitely.
change anything about the system. Neither of those positions, Andrew, are wrong. They're just different. They're just a reflection of where people are in that process.
Yeah, yeah. And it's a free-ish market, right? And if you want to play the game of adults, then you're going to have to accept that there's going to be some hard stuff.
Yeah, but even that, I mean, I would argue that hard stuff, and maybe I wouldn't have seen this 20 years ago, but I do now. That hard stuff's actually part of you get to. I mean, I'm 50. I'll be 58 in a couple of months' time, and I've done okay. Considering I was that little kid from lower socioeconomic beginnings. And I look back now, and I'm kind of proud of it. I'm kind of proud of the fact that I haven't had any advantage or privilege or any of these other things. So I've done all that stuff myself. I wouldn't want that to have been handed to me. It might have been nice for my mum and dad to have had some equity and helped me with a house plate. They were in a position to do that. But in the longer run, it's part and parcel of what makes life worthwhile.
That's the thing, it's compounding, and if you're compounding from an early start, then great. If you don't put effort into compounding, even if it's turning 1 into 1.08 into 1.17, it takes a long time.
It does.
But if you're not compounding, you'll never hit it. But if you do compound, then you'll hit it eventually.
Couldn't agree more. And the key to that is get on the ladder. Do whatever you need to get on the ladder.
And if you need to move to a different city or partner up with some other people, then
so be it.
So be it. So what is there anything like that these lockdowns or this whole 2-year situation has helped shape or change your investment philosophies or tactics that you think's worth passing on?
No, because I'm in for, believe it or not, I'm a very conservative investor. So I keep I mean, I probably could have done a lot better if I'd been prepared to take some risk that I wasn't. So I keep my eye on the long game. My end goal has always been about retirement. It's always been, because I've always earned reasonably good money. Well, certainly in more recent years, I've earned reasonably good money from the roles that I've had. So the investment strategy has always been about what do I do when I retire. So my strategy's always been about buy and hold for the long term. For somebody who wanted to do well more quickly, there are ways to do that. Which I wouldn't do because I'm not brave enough. But there are certainly different strategies out there for people who want to get through things more quickly.
And move to the Hawke's Bay maybe is the if you're watching in Auckland, you can't get what you need. It's still not cheap down there either.
Well, it's about 80% of Auckland prices now, so it's not that much cheaper. But you get generally a better quality of home. And it's a nice place. Hey, and don't get me wrong, I love Auckland. Auckland's my sort of spiritual home, so I certainly haven't abandoned it. But there's certainly something to be said for the regions at the moment in terms of what you can and can't do with your money. Yeah,
and just probably getting out of the city life when everybody's so stressed is probably brings with it a little bit more of a relaxed atmosphere. Even if it's stressful down there, sometimes I could tell you sometimes in Auckland.
Yeah, they have a rush minute.
Yeah,
when there's a whole lot of cars for about 90 seconds, so that's stressful. But no, there's pros and cons. It's much slower down here. I mean, I walk down the street, and great empires have risen and fallen in the time it takes somebody to walk down Emerson Street in Napier. Yeah. But overall, it's certainly got its advantages and benefits.
All right. Well, thanks for your time.
You're very welcome.
Where should we? You've got a property blog? Do you have a link or anything, or is it just One Roof's best place to read what you're putting out?
Yeah, two actually. So One Roof, obviously for my property commentary. For those who are foolish enough to want to know my views on a range of topics that aren't necessarily property related, ashleychurch.com, cool. Which is my own website, which as I say has a bit of property, but it's also got my various rants and bleatings on all sorts of other topics which may or may not be of interest, and you can subscribe just by putting your name into a box which will appear on that site if you visit it.
Perfect. All right. Thanks very much.
You're very welcome. Okay.